Hi guys! Welcome back to my part 3 of my basic accounting tutorial, Accounting the Easy Way for Non-Accountants. So let's start! Learning objectives natin ngayon guys. After this tutorial, you should be able to know the different accounting principles, know the different accounting assumptions, know the different business structures. The accounting principles and assumptions provides us ideas on how these financial statements are prepared and being trusted by external users. General principles consist of at least 4 basic principles and 4 assumptions. So, what are the different accounting principles? There are 4 basic accounting principles. The measurement principle, also called the cost principle, usually means that accounting information is based on actual costs, with a potential for subsequent adjustments to market. Cost is measured on cash or equal to cash basis. This means if cash is given for a service, its cost is measured as the amount of cash paid. If something besides cash is exchanged, such as a car traded for a truck, cost is measured as the cash value of what is given up or received. The cost principle emphasizes reliability and verifiability, and information based on cost is considered objective. Objectivity means that information is supported by independent, unbiased evidence. It demands more than a person's opinion. The revenue recognition principle provides guidance on when a company must recognize revenue. Revenue, sales, is the amount received from selling products and services. To recognize means to record it. So, kailan ba tayo mag-recognize ng revenue? Revenue is recognized when earned. The earnings process is normally complete when services are performed or a seller transfers ownership of products to the buyer. Proceeds from selling product and services need not be in cash. A common non-cash proceed received by a seller is a customer's promise to pay at a future date is called credit sales. So, ito yung nabinta mong products or services pero utang nga lang. The expense recognition principle, also called the matching principle, prescribes that a company record the expenses it incurred to generate the revenue reported. In other words, all expenses must be recorded in the accounting period as the revenue which they help to generate. The full disclosure principle requires financial statements of a business should be complete and should report sufficient information relating to the business entity to make the statements understandable. Here's now the 4 accounting assumptions. The going concern assumption, the monetary unit assumption, the time period assumption, and the business entity assumption. The going concern assumption means that accounting information reflects a presumption that the business will continue operating instead of being closed or sold. The monetary unit assumption requires that companies include in the accounting records only transaction data that can be expressed in money terms. This money is the common denominator. Examples of monetary units are the dollar in the United States, Australia, and Singapore, and the peso in Mexico, the Philippines, and Chile. The time period assumption presumes that the life of a company can be divided into time periods such as months and years, and that useful reports can be prepared for those periods. The business entity assumption means that a business is accounted for separately from other business entities, including its owner. The reason for this assumption is that separate information about each business is necessary for good decisions. A business entity can take one of three legal forms: proprietorship, partnership, or corporation. A sole proprietorship or simply proprietorship is a business owned by one person. No special legal requirements must be met to start a proprietorship. The owner-proprietor receives any profits, suffers any losses, and is personally liable for all the debts of the business. This means, for example, that a court can order an owner to sell personal belongings to pay a proprietorship's debt. So, lahat ng ari-arian ng may-ari ay maaaring kunin ng kreditor pang bayad utang. Isa ito sa mga major disadvantages ng sole proprietorship. Ang tawag nito ay unlimited liability of a proprietorship, meaning the creditor can go after the personal assets of the owner. In other words, there is no legal distinction between the business as an economic unit and the owner. But the accounting records of the business activities are kept separate from the personal records and activities of the owner. Halimbawa, kung bibili ako ng makeup para sa personal use, hindi ko ito i-record sa books ng aking negosyo dahil personal nga at hindi naman ito ginagamit para sa aking negosyo. Next, guys, is the partnership. Partnership, a business owned by two or more persons associated as partners, is a partnership. Like a proprietorship, no special legal requirements must be met. In starting a partnership, the only requirement is an agreement between partners to run a business together. The agreement can be either oral or written and usually indicates how income and losses are to be shared. A partnership, like a proprietorship, is not legally separate from its owners. Each partner generally has unlimited personal liability for the debts of the partnership, meaning that the creditors can go after the personal property of the partners. Like a proprietorship, for accounting purposes, the partnership transactions must be kept separate from the personal activities of the partners. And the last one is the corporation. A business organized as a separate legal entity under corporation law and having ownership divided into transferable shares of stock. The holders of the shares or stockholders enjoy limited liability, that is, they are not personally liable for the debts of the corporate entity. Limited liability, meaning that the creditors cannot go after the personal property of the owners or stockholders of the corporation. Stockholders may transfer all or part of their ownership shares to other investors at any time. That is, selling their shares. The ease with which ownership can change adds to the attractiveness of investing in a corporation. Because ownership can be transferred without dissolving the corporation enjoys an unlimited life. Ownership of all corporations is divided into units called shares or stock. When a corporation issues only one class of stock, it is called common stock or capital stock. Bago tayo magpatuloy, kung bago ka pa lang sa aking channel, baka gusto mong mag-subscribe, mag-like, at i-share ang tutorial na to. Maraming salamat! Here is a simple comparison of these three types of business structures. Number of owners under sole proprietorship is single individual, and in partnership, 2 or more individuals, and in corporation, 1 or more owners. Ease of formation. Under sole proprietorship, easier to form. Under partnership, harder to form. Under corporation, difficult to form. Ability to raise capital. Under sole proprietorship, difficult to raise capital. Under partnership, harder to raise capital. Under corporation, easier to raise capital. Liability risk. Under sole proprietorship, unlimited liability. Under partnership, unlimited liability. And in corporation, limited liability. Business tax. Under sole proprietorship, no. Under partnership, no. Under corporation, yes. Legal entity. Under sole proprietorship, no. Under partnership, no. Under corporation, yes. Unlimited life. Under sole proprietorship, no. Under partnership, no. Under corporation, yes. Thank you guys for watching. Please don't forget to share, like, and subscribe. Bye!